Welcome to another edition of Market Insights. This is Steve Fernandez with Smart Profits Daily. I'm excited for today's episode. I'm going to talk to you about the SPAC mania we're witnessing. I'll give you my thoughts on that. Then I'm going to go through a framework you can follow to actually pick SPACs to invest in. So please support our channel. Go ahead and hit that like button and the subscribe button if you like our content. And after you hit the subscribe button, you can hit the bell icon. That's going to set you up for instant alerts whenever we release a Market Insights video. So first things first, I'm just going to briefly touch on what a SPAC is. It stands for a special purpose acquisition company. So sometimes these are referred to as blank check companies. They exist for one purpose, and that's to gather cash and then use that cash to take another company to the public markets. Kind of like an IPO, but there's a little bit of an advantage right now for companies that want to go public via SPACs. The first being more certainty about what their transaction value is going to be when they sell their company. So a SPAC and a company actually agree on the merger terms ahead of time, and the company can have confidence that their deal value is going to be pretty close to where they agree on, so what their company is going to be worth. This is different from an IPO, where companies that go public via IPO, they're not quite as sure. The valuation of an IPO fluctuates ahead of the IPO based on competitor valuations and investor sentiment towards the industry and that company. Another reason SPACs are superior to IPOs is because they can improve the speed to market for companies. And this is even more critical right now, where investors are really bidding up themes in a frenzy. For example, companies that have involvement in energy storage or electric vehicles or autonomous vehicles, whether that be the vehicles themselves or LiDAR components. Investors are buying these themes now. So SPACs enable companies to get to the public markets now and capitalize on that high demand and sell their companies at premiums. So with that frenzy that I just described, we're really seeing a SPAC bubble, and I think at the core it goes down to supply and demand. The way that SPACs are structured is not all of the SPAC shares are actually tradable up front. So the public SPAC shares pre and post merger are not all of the company's shares. In fact, there's a lot of shares that are owned by insiders and then investors known as private investors in public equity. So they can't sell their shares usually for 6 to 12 months, and that's because of a provision called a lockup provision. With a lockup provision, it actually caps the outstanding supply, and with a small supply and a large investor demand, it typically results in a price increase. And I think that can explain the amplified price gains we're seeing on these SPACs and their companies after they merge, because there's just no shares to supply the demand. I don't think this is going to last forever. The supply will eventually normalize as the lockup periods terminate. So you'll see in a lot of cases, these SPACs and eventually their companies will trade down into the lockup period, and then sometimes after, not always, but it happens a lot. So be aware of that when you're buying these SPACs, especially if they have risen a lot and you're buying after a large price move. You can trade the momentum, and that's good, but if you're investing, you also need to be aware that some of these companies are not going to be big time companies. They're going to end up being duds. And what I mean by that is they may not actually meet the criteria that you expect. They may not be disruptors in their industry like you think, and they may not actually be competitors in that industry either. But they're getting their prices bid up because of the SPAC mania we're seeing now. Now, don't get me wrong, I'm not criticizing buying SPACs. In fact, we've made quite a bit of money for our readers by recommending SPACs, good quality SPACs that readers could invest in. So that brings me to my next point, a framework for picking SPACs. Now, this is what I follow personally, and I think it's a good framework that you could follow as well. First, I separate SPACs into two buckets. The first bucket being a SPAC with no target company announced. So this means that it's quite literally just a pile of cash. Now, this pile of cash can be assessed by three criteria. The first being the management team. The second being what type of guidance are they giving? What type of industry or target company are they looking to merge with? And then what type of institutional investors or investors are they attracting to buy the SPAC? Ideally, we would like to see the management team aligned with whatever their guidance is. So if they're guiding to acquire an electric vehicle company, ideally we want to see management team with previous exposure, whether it be an executive seat or some sort of technological expertise or even intellectual property from that industry that they can take with them when they decide on what company to acquire. And when institutional investors have skin in the game on SPACs, it gives you a little bit of peace of mind that there might be something going on there that warrants a second look. Now, the second bucket is when there's a known target or the company has already completed their business combination. So in this case, it's easier to analyze the company because, well, it's known. So in this case, you want to look at the industry that that company is in. So what type of industry, what is their objective in that industry? Once you know that, you can assess the addressable market. So what type of market is this company able to penetrate? Whether it's $1 trillion market or tens of billions, it's going to vary, but you can assess that, and with assistance from their investor presentation, which is generally pretty good, and the company management team in this case is more important than the SPAC management team, in my opinion, because this is the company's driver moving forward. So you're going to want to look at what is their expertise and what experience do they have building companies. And last, and maybe the most important, is disruption. What type of product or service does this company have that's either A, going to fill a gap in society or where technology is lacking, or how are they going to add value or enhance the industry? That's something to keep in mind, and that's really what's going to give you those huge outsized returns, finding those companies. And business operations is also important to consider because current customers and current revenue, a bird in hand, I guess you could say, is always important. And future revenue and contracted customers years out is also important. Ideally, we want to see companies that have already started commercialization, they already have sales, or they have contracted sales out. If you have both, obviously that's the best scenario. But even if you don't have contracted revenue or revenue now, there's really got to be something with that company that makes them a threat and a competitor moving forward. That could be very good technology that's unparalleled, and that might be a reason to buy that specific company despite no revenue. And lastly, with the margins, meaning profitability, it's expected that some of these companies may have low margins starting out because they're very young in their growth trajectory. But you want to see that these companies' margins will expand and they'll become more profitable as they grow. That's a good business model at its core. So you can actually find a lot of this information, at least when the target is known, by looking at investor presentations that the companies will produce and present. These are generally pretty easy to comprehend, and they give you a lot of this information that I just mentioned to you, and it should help you really look for SPACs that you find quality long-term investments. So that's going to do it for today's Market Insights. I really hope you enjoyed it. If you did, make sure you leave a comment, like the video, and subscribe, and we will talk to you next time.